Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 28th year in business. It's Thursday morning, March 2nd, 2017, and the title of this week's audioblog is Pick Your Poison, Stagflation or Hyperinflation. There are so many places I can start this morning, but the clear winner of the PM bullish, everything else, except Bitcoin, bearish sweepstakes is a fiery 2-minute speech given by Marine Le Pen at the European Parliament this week, in which she viciously attacks soon-to-be former President of France, Francois Hollande, and soon-to-be former Chancellor of Germany, Angela Merkel, right in front of their faces, which you can watch by Googling Marine Le Pen savages Merkel to her face in the EU Parliament. To wit, some will summarize by saying I'm the anti-Merkel, which is an honor for me. I don't acknowledge you, Mrs. Merkel. Germany's interests don't justify the vassalization of the other people of Europe. I am here the voice of the free Europeans, of our sovereign nations that show their back to the European Union because they want nations. And I am a representative of the French people who turn their back on you, Mr. Hollande, like they turn their back on Sarkozy because they are fond of France. This as the Centix Euro Breakup Contagion Risk Index touched an all-time high of 48 this morning, nearly double the 25 level of last spring and triple the 15 level of early 2012. Just before the European sovereign debt crisis of mid-2012, which prompted Mario Draghi's historically infamous whatever-it-takes speech. Even then, this index never exceeded 45, to give you an idea of just how close the European Union, and with it, the world's second-largest currency, is to the abyss. Which at this point is just one political shock from being far more dramatically discounted, starting with the euro's inevitable rendezvous below dollar parity, which may well occur after the Dutch election on March 15th, a mere 2 weeks hence. At which point, the LOL dollar index will soar to multi-year highs for the millionth time, not due to U.S. economic strength, but, per the title of 4 articles I've written on the topic, the latest just 2 weeks ago, due to the political equivalent of a nuclear bomb hitting Europe. This, as European inflation readings are soaring, as highlighted by yesterday's report that the German CPI hit its highest level in 5 years. Its banking system is collapsing, as highlighted by last week's EU warning that Italian debt is spiraling out of control, and the odds of dramatic regime change have never been higher. To that end, the Netherlands' Geert Wilders is all but assured of winning the Dutch election on March 15th, which the desperate globalist propaganda continues to push back against by, likely incorrectly, asserting he won't have enough support to form a coalition government even if he wins. Yeah, like Donald Trump needed to form a coalition government when he shattered the powers that be's hopes by defeating the globalist candidate of choice, the Wicked Witch of the Western Hemisphere. Although in Hillary Clinton's defense, perhaps Angela Merkel has her beat in that arena, relegating Hillary to Wicked Witch of the East status. As for Germany, the out-of-the-blue candidate Martin Schulz has surpassed Merkel in the polls, although it's unclear exactly what his vision of a new Germany is. Whilst in Italy, the breakup of Matteo Renzi's Democratic Party last week opens a door for the Five-Star Movement to potentially take power when snap elections are inevitably scheduled later this year. While the equally inevitable Grexit is just one broken Troika negotiation away, with the odds that the money it desperately needs to pay back said Troika in July weakening with each passing day. In Catalonia, a final secession referendum is tentatively scheduled for September, despite the Spanish government pulling out all possible legal means to stop it. And word is that Scotland will again schedule a UK secession referendum, given that, unlike England and Wales, Scotch citizens decidedly voted against the Brexit referendum. And finally, there's the big daddy of them all, the French presidential election, which as recently as last week had Le Pen atop the polls, whilst the majority of competing candidates' numbers were steadily declining. Most notably, the man who was considered her primary competition, former Prime Minister Francois Fillon, who continues to remain in the race despite having criminal charges leveled against him for embezzling EU funds. There, the political battle heading up to the most important election in European history is putting the Trump-Clinton war to shame, with more lies, propaganda, and dirty tricks than any I've ever seen in a civilized country. With said powers that be appearing so desperate, they are now trying to convince us that the 39-year-old French finance and economy minister, Emmanuel Macron, out of the blue, is going to win. Which he won't. when Marine Le Pen culminates the movement started by 2015's Greek Oxy and Catalonian secession results, 2016's Brexit, Trump, and Italian referendum results, and 2017's soon-to-occur Dutch result by storming the Bastille with a European Union-destroying victory in the two-stage French election to be held in April and May. At which point it will be game over for the powers that be's last stand in Europe, as no amount of market manipulation will be able to overcome the tsunami of speculation regarding the horrific near-term political, economic, and financial ramifications of a broken European Union. At which point the desperation for Europeans and the citizens of other nations whose currencies are pegged to the euro to get their hands on physical gold and silver will be likely as powerful as the desperation that caused wholesale shortages and massive premium increases at the height of the 2008 financial crisis. Of course, said ramifications will be global in nature, empowering anti-establishment movements that in some cases have been white-hot and in other cases merely simmering, including here in the States, where said war between the increasingly polarized pro- and anti-Trump factions will be taken thermonuclear. And by pro- and anti-Trump factions, I am not referring to Democrats and Republicans, as frankly I think both parties, for all intents and purposes, were destroyed last November. No, today's factions are simply those seeking to commandeer American freedom, i.e. the neoliberals as represented by Hillary and Bill Clinton, and those seeking to defend it, which I assure you will only get bloodier with each passing day, as evidenced by said neoliberals having already taken out Trump's National Security Advisor Michael Flynn and their current attempt to take out newly appointed Attorney General Jeff Sessions. And God only knows how bloody the Supreme Court justice approval process will become, let alone the looming debt ceiling crisis that hangs over America's head less than 2 weeks away. Yes, that little old thing known as the debt ceiling, which, testifying to just how indiscernible the Democrats' and Republicans' actual goals are, was suspended in a rare bipartisan agreement in November 2015, enabling the Obama administration to borrow and spend America into oblivion in the lead-up to the all-important 2016 election, which it decidedly lost when the ultimate outsider upended their efforts to seal America's doom with the Hillary Clinton victory. To that end, to this day, I cannot imagine why the Republicans allowed said debt ceiling suspension to occur, other than the Spock-like logic that they too actually wanted Hillary to win. That said, America's debt ceiling is one of the longest-running farces of its rapidly crumbling political legacy, having been raised 74 times since March 1962, including 18 times under the LOL conservative Ronald Reagan, 8 times under Bill Clinton, 7 times under George W. Bush, and only 5 times under Barack Obama, because A, the increases under his administration were the largest, and B, the debt ceiling was suspended for the final year of his reign of terror. Putting America's debt growth into perspective, and generally speaking the Ponzi scheme it represents, America's national debt growth, excluding $5 trillion from the 2008 nationalization of Fannie Mae and Freddie Mac, which are held, LOL, off balance sheet, was 186% under Reagan, 54% under George Bush Sr. in just 4 years, 32% under Clinton during the fraudulent boom times of the post-Glass-Steagall internet bubble, 101% under George W. Bush, excluding the aforementioned off-balance sheet nationalizations, and 68% under Barack Obama. Of course, in actual dollar terms, the true nature of the U.S. government Ponzi scheme that commenced on August 15, 1971 is revealed, as while Reagan's 186% national debt increase amounted to just $1.9 trillion, Bush Sr.'s 4-year increase was a whopping $1.6 trillion, nearly as much as Reagan added in 8 years, followed by Bill Clinton just adding $1.4 trillion during what many believe, fallaciously so, was America's most prosperous economic time. After which the true nature of America's economic collapse was revealed in full force by the $5.8 trillion added by George W. Bush and $7.9 trillion by Barack Obama. This before the self-proclaimed king of debt took office in January, who, by the way, could just as easily be deemed the king of bankruptcy, which is exactly where America is headed, either via outright default, or as Trump would put it, debt restructuring, or more likely the inflationary route that all fiat currency schemes have resorted to throughout history, in many cases of the hyperinflationary ilk. Anyhow, as of March 15th, America's debt ceiling will be locked in at roughly $20.1 trillion. This compared to the $14.1 trillion level that caused America's laughable AAA credit rating to be stripped by Standard & Poor's in August 2011, causing a dramatic financial crisis resulting in dollar-priced gold hitting an all-time high of $1,920 per ounce a month later, before the cartel went all in with 24/7 market manipulation to push it and silver, which had recovered from May 2011's Sunday night paper silver massacre to nearly $45 an ounce, back down. And conversely, to make sure systematically important indices like the Dow Jones Propaganda Average would never again decline. At least that was the game plan then, which I assure you won't succeed forever. In the ensuing 5.5 years, not only has the national debt increased by $6 trillion, but America's economy has weakened to its lowest level since the Great Depression, which arguably was a much stronger time for the U.S. economy, given that the gold standard had kept America essentially debt and inflation free. And oh yeah, its manufacturing base was in the process of growing to a level which a few decades later was the world's strongest. Today, America is the most debt-infested nation in global history, with no manufacturing base and an increasingly negative diplomatic following, leaving it with just one remaining advantage, i.e. the reserve currency status ceded to it at Bretton Woods in 1944, which still remains despite having been reneged on by Nixon in 1971, and quite obviously appears destined to be lost as the dollar is inflated into oblivion, and the world becomes increasingly enraged by the Fed's and the U.S. government's deleterious impact on global trade and monetary policy. And oh yeah, the rise of decentralized currencies like Bitcoin, which appear destined to replace the government-issued, central bank-abused fiat currencies that have destroyed billions of people's lives. Back to said debt ceiling suspension, or as the MSM euphemistically deems it, a holiday. As of March 15th, the Treasury cannot fund any new ventures until a new ceiling is established, which, given the costs of embedded government spending requirements, let alone the massive fiscal expansion Trump desires, would have to be at least $2 trillion higher just to get it through the first year or so. Until that time, the Treasury will likely have no more than $250 billion of cash to sustain the government, which even its best accounting gimmickry, like borrowing from federal pension funds, won't buy more than 3 months' time before it is completely drained. Thus, amidst the backdrop of the most contentious partisan government in U.S. history, including countless anti-Trump Republicans who likely hate him as much as the Democrats, Congress will commence a debt ceiling battle like nothing ever witnessed in U.S. history. This, whilst countless other political wars are being simultaneously fought, like the inevitably futile attempt to repeal and replace Obamacare, appoint a swing-voting Supreme Court justice, massively overhaul the tax code, and legislate an equally massive fiscal stimulus funded entirely by debt for projects with little or no returns on investment. In other words, as David Stockman put it last week, everything will grind to a halt on the Ides of March, which I might add also happens to be the day of not only the potentially historic Dutch election, but potentially an equally historic FOMC meeting. All three of which, and potentially all three, have the potential to wreak havoc on global financial markets, particularly gold and silver, which both are perched right below the key technical resistance levels of their 200-week moving averages of $12.60 per ounce and $18.60 per ounce, respectively, which quite obviously the cartel is currently defending with every remaining weapon in its manipulatory arsenal. Kind of like the grand finale of a fireworks display when every last firework is launched. Which brings me to my next topic, which is perhaps the most egregious and reckless example of central bank folly in U.S. history, which, if it is actually carried through, will undoubtedly catalyze the most violent trade and currency wars since the Great Depression. Only this time, given how America, and the entire world for that matter, is amidst an historic debt explosion, will end as catastrophically as it does quickly, which is this week's concerted Fed effort to convince us they intend to in fact raise rates 3 times this year, as promised in December, which, given last year's failed promise to deliver 4 rate hikes, let alone its to-date unkept and eminently impossible 2013 promise to reduce its $4.5 trillion balance sheet of toxic, historically overvalued Treasury and mortgage-backed bonds, the market was decidedly not assuming this would occur. That is, until hours before Trump's State of the Union speech on Tuesday. during which zero substantial information was disseminated, I might add, just one day after Trump told a roundtable of America's largest manufacturers that he would not allow an artificially strong dollar to continue to kill their business prospects. And FYI, let's just, for but a moment, ignore the fact that said strong dollar is far from the biggest reason America's manufacturing leadership has vanished. Yes, mere hours before said speech, not one, not two, but three separate Fed governors suggested a March rate hike was likely. Despite the relentless weakness in hard economic data that caused the government's historically cooked GDP to grow at just 1.9% in the fourth quarter, while its first quarter expectations were being ratcheted down to roughly 1.5%. Yes, my friends, despite the historic surge in soft economic data like consumer confidence, the Atlanta Fed's GDP nowcast was reduced yesterday after a horrific, unexpected plunge in construction spending, a lethargic increase in personal spending, and a 9-year high trade deficit to just 1.8%, whilst Goldman Sachs reduced it to 1.5% and Bank of America all the way down to 1.3%. But don't worry, all's well, as the PPT has been able to ignite a bigger stock market bubble than even the top of the dot-com blow-off. Despite the worst economy in generations, the most uncertainty since World War II, the highest debt ever, and not a chance in hell of even Trump's Faustian bargain economic plans occurring. Let alone as said debt ceiling crisis looms dead ahead, as well as the potential breakup of the European Union. Anyhow, whether it was to save face, attack Donald Trump's weak dollar aspirations, or, as Bix Weir would postulate, as part of a deliberate attempt to take down America from within, the Fed has apparently decided to move forward with a March rate hike, despite the aforementioned historic political uncertainty and hard economic data at multi-month and in many cases multi-year lows. True, the comically government-suppressed inflation readings have been well above the Fed's supposed 2.0% target for many months, ironically caused in large part by the U.S. government-supported oil PPT's efforts to prevent oil prices from being priced where the historic oil glut would put them in freely traded markets. And true, if one were to take the government's equally comically goosed employment reports at LOL face value, or heck, today's 44-year low in weekly jobless claims, caused entirely due to the fact that, due to draconian government and regulations like Obamacare, they have turned America into a gig economy where the vast majority of workers are ineligible for unemployment benefits, one could easily make the fallacious assumption that a rate hike from the historically low level of 0.5% to an equally zero-like level of 0.75% was warranted. However, in light of the fact that the real economy has never been in worse shape, let alone that it is theoretically the third longest in U.S. history and thus ripe for recession, and oh yeah, the very Fed action of suggesting policy tightening is causing interest rates and the dollar to rise, further choking off economic growth, an actual act to raise rates, this, as all other central banks are going the opposite direction, can practically speaking be viewed as nothing less than economic suicide. Much less when the president himself is vehemently endorsing a weaker dollar due to his belief that American manufacturers are getting killed by serial currency manipulators like the Chinese, Japanese, and Germans. Not to mention that such reckless jawboning, whose ramifications are stark enough, if the past 2 days' dollar surge is any indication, will pale in comparison to the hell that will be unleashed if they actually follow through with a rate hike. God forbid if they do so with associated higher-than-expected hawkish intonation. As immediately the dollar index will take out the 14-year high of 103 hit 2 months ago, with the 17-year high of 118 clearly becoming an obtainable target, particularly if Wilders simultaneously wins the Dutch election, and particularly if Marine Le Pen wins the French election 2 months later. Although clearly the U.S. debt ceiling issue is a key wildcard in this process, as well as who knows how many potential black and gray swan events. And trust me, with every basis point increase in the dollar index, which as I speak is at 102, the PBOC will commensurately ratchet down the onshore yuan, sparking heightened speculation in the offshore yuan market of the cataclysmic financial big bang to end all big bangs major devaluation that must inevitably occur anyway. And if the Fed continues to suicidally push up the value of the dollar index, said inevitability will rapidly turn to imminence. Remember, all hell nearly broke loose just 2 months ago, when the yuan-dollar exchange rate came within a hair's breadth of breaking above the key psychological level of 7.0. before LOL plunging all the way to 6.78. Well, it's back up to critical resistance at 6.88 this morning. And trust me, if said 14-year high of roughly 103 is breached on the dollar index, which a Fed rate hike nearly guarantees, ceteris paribus, you can bet 7.0 will be taken out like a knife through hot butter. This with China's foreign exchange reserves having already fallen to a multi-year low, which I assure you will be dramatically reduced by the ensuing capital flight, which in turn will cause the PBOC to step up the draconian capital controls announced at year-end, which is probably why Bitcoin hit a new all-time high this morning and why historically undervalued precious metals, particularly here in the States, i.e. the center of gold manipulation, once the aforementioned explosion of currency debasement causes physical demands to overwhelm the paper-dominated cartel, will inevitably do the same. Which brings me to today's final, ultra-important topic. Although frankly, there are a half dozen others worth discussing, if the 8 pages of notes I've gathered in the past 24 hours are any indication of the scope and breadth of PM bullish, everything else except Bitcoin bearish headlines I'm watching. Which is the question of how much the current historically overvalued markets movement is due to pure PPT engineered manipulation, and how much due to the beginnings of discounting hyperinflation. Which, if the gold cartel weren't throwing everything but the kitchen sink at precious metals, the Fed wasn't covertly monetizing the billions of treasuries being sold by the Chinese, Japanese, Russians, and Saudis, and the dollar wasn't being artificially supported by the accelerating collapse of the European Union, would likely be patently obvious by now. I mean, does the PPT really want the Dow Jones propaganda average to trade at a valuation above that of the dot-com peak? Or real estate prices above the 2007-2008 pre-financial crisis bubble highs? Particularly commercial real estate, which is 25% above that level despite the retail brick and mortar industry collapsing? And with all of the horrific economic and political events swarming around them? Much less, does the U.S. government really want the dollar to rise to levels that destroy the ability of emerging market nations to pay off the massive amount of dollar-denominated debts they've incurred, while at the same time inviting the Chinese to vaporize the global economic and political landscape with a major devaluation? Perhaps, particularly if you believe, as some do, but I do not, that a grand conspiracy to take down America from within is afoot. Then again, after Donald Trump shocked the powers that be by taking the presidency, it couldn't be clearer that efforts to sabotage him at all costs are in fact occurring. Which may well include the Fed itself, given what I believe to be, as discussed above, their economically suicidal attempts to convince the markets, in direct confrontation with the president's vehemently stated goals, that significant monetary policy tightening is imminent. Which, I might add, I have on countless occasions, using reams of empirical data, irrefutably proven to decidedly not be bad for precious metals, and to the contrary, if history is any guide, decidedly good for gold and silver. Let alone today, given the historic debt edifice America faces, particularly if rates rise further, the ongoing and accelerating collapse of dozens of fiat currencies, including major currencies like the euro and pound, and oh yeah, the historic cartel suppression that has arguably reduced dollar-priced gold and silver to their most undervalued levels in generations, if not centuries. And given that irrefutably, it's not inflation that's currently strangling the world's desperate central bank-fueled attempts to escape the inescapable death blow to history's largest, most destructive fiat Ponzi scheme that the 2008 financial crisis provided, but stagflation, the only remaining question in my mind is whether actual interest rates, as opposed to the Fed-controlled federal funds rate, like that of the bellwether 10-year Treasury yield, will actually break significantly higher, irrespective of what the Fed says or does. As trust me, if the economic line in the sand at 2.5% I drew 2 months ago in my 2.5% enough said article is broken, let alone the 2014 high of 3% that catalyzed taper tantrum financial market turmoil, will be dramatically amplified if it were to make an encore appearance today. If not, then indeed stagflation will be what the market is discounting, as given the aforementioned political, economic, and financial factors, there is simply no way a material economic recovery is possible at this point. But if so, I would conclude that in fact, hyperinflation discounting is what is commencing, starting with the government-supported sectors like stocks, oil, and base metals, but inevitably ending with the overwhelming of manipulative efforts in unfavorable asset classes like interest rates, precious metals, and oh yeah, Bitcoin. The latter of which, I might add, is just 1 week from the March 11th deadline for the Winklevoss ETF to be approved or disapproved by the SEC. For the record, I, like most market participants, if the betting lines are to be trusted, do not believe it will be approved, although watching the action today, it seems like someone may know something. As frankly, the government would be nuts to approve a vehicle enabling mainstream adoption of a rapidly emerging asset class that could prove to be as much or perhaps more of a competitor to their dying fiat dollar than even gold. To that end, if they do, I will more than ever believe a concerted effort to undermine America, or perhaps just Donald Trump himself, is at this point, fiat currency has never been more vulnerable. And particularly the dollar, even if said vulnerability is not against lesser fiat trash, but real items of value like gold, silver, Bitcoin, and the vast majority of things one needs to survive, like food, shelter, insurance, education, and healthcare. Before I go, I advise everyone to read Steve St. Angelo's fantastic new article titled New Uncovered Information, Why Central Banks Were Forced to Rig the Gold Market, in which he shows proof of how the post-London gold pool cartel suppressed prices. And as well, Craig Hemke's equally fantastic article from a month ago, 42 Years of Financial Alchemy, where equally irrefutable proof that the COMEX was created solely to suppress prices is given, in a 4-decade-plus manipulation operative that is rapidly approaching its final spectacular end. To that end, the need to protect yourself from what's coming, financially and otherwise, has never been more urgent. And if your desired protection prescription is precious metals, we humbly ask you to call Miles Franklin at 800-822-8080 or go to milesfranklin.com and register for online purchasing and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much. 15th, which the desperate globalist propaganda continues to push back against by, likely incorrectly, asserting he won't have enough support to form a coalition government even if he wins. Yeah, like Donald Trump needed to form a coalition government when he shattered the powers that be's hopes by defeating the globalist candidate of choice, the Wicked Witch of the Western Hemisphere. Although in Hillary Clinton's defense, perhaps Angela Merkel has her beat in that arena, relegating Hillary to Wicked Witch of the East status. As for Germany, the out-of-the-blue candidate Martin Schulz has surpassed Merkel in the polls, although it's unclear exactly what his vision of a new Germany is. Whilst in Italy, the breakup of Matteo Renzi's Democratic Party last week opens a door for the Five-Star Movement to potentially take power when snap elections are inevitably scheduled later this year. While the equally inevitable Grexit is just one broken troika negotiation away, with the odds. Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 28th year in business. It's Thursday morning, March 2nd, 2017, and the title of this week's audio blog is Pick Your Poison, Stagflation or Hyperinflation. There are so many places I can start this morning, but the clear winner of the PM bullish, everything else, except Bitcoin, bearish sweepstakes is a fiery 2-minute speech given by Marine Le Pen at the European Parliament this week, in which she viciously attacks soon-to-be former President of France, Francois Hollande, and soon-to-be former Chancellor of Germany, Angela Merkel, right in front of their faces, which you can watch by Googling Marine Le Pen savages Merkel to her face in the EU Parliament. To wit, some will summarize by saying I'm the anti-Merkel, which is an honor for me. I don't acknowledge you, Mrs. Merkel. Germany in just one political shock from being far more dramatically discounted, starting with the euro's inevitable rendezvous below dollar parity, which may well occur after the Dutch election on March 15th, a mere 2 weeks hence. At which point, the LOL dollar index will soar to multi-year highs for the millionth time, not due to U.S. economic strength, but, per the title of 4 articles I've written on the topic, the latest just 2 weeks ago, due to the political equivalent of a nuclear bomb hitting Europe. This, as European inflation readings are soaring, as highlighted by yesterday's report that the German CPI hit its highest level in 5 years. Its banking system is collapsing, as highlighted by last week's EU warning that Italian debt is spiraling out of control, and the odds of dramatic regime change have never been higher. To that end, the Netherlands' Geert Wilders is all but assured of winning the Dutch election. On March 10th, that the money it desperately needs to pay back said troika in July, weakening with each passing day. In Catalonia, a final secession referendum is tentatively scheduled for September, despite the Spanish government pulling out all possible legal means to stop it. And word is that Scotland will again schedule a UK secession referendum, given that, unlike England and Wales, Scotch citizens decidedly voted against the Brexit referendum. And finally, there's the big daddy of them all, the French presidential election, which as recently as last week had Le Pen atop the polls, whilst the majority of competing candidates' numbers were steadily declining. Most notably, the man who was considered her primary competition, former Prime Minister Francois Fillon, who continues to remain in the race despite having criminal charges leveled against him for embezzling EU funds. There, the political battle heading up to the most Germany's interests don't justify the vassalization of the other people of Europe. I am here the voice of the free Europeans, of our sovereign nations that show their back to the European Union because they want nations. And I am a representative of the French people who turn their back on you, Mr. Holland, like they turn their back on Sarkozy because they are fond of France. This as the Centix Euro Breakup Contagion Risk Index touched an all-time high of 48 this morning, nearly double the 25 level of last spring and triple the 15 level of early 2012. Just before the European sovereign debt crisis of mid-2012, which prompted Mario Draghi's historically infamous whatever-it-takes speech. Even then, this index never exceeded 45, to give you an idea of just how close the European Union, and with it, the world's second-largest currency, is to the abyss, which at this point is